All right, guys, I am back again with another video. And in today's video, I want to take time to show you how institutional traders trap retail traders when trading the markets. So do you know what a bear trap is or a bull trap is? Do you know where those bear traps and bull traps most often happen? Well, I'm about to show you. So stay tuned as I show you how institutional traders are trapping you and how you can watch out for it and spot areas where that is happening. All right, guys, so let's get right to it. All right, guys, so let's talk about how you guys are getting trapped with these institutional traders, and sometimes you just don't even realize it. So a lot of times, those breakout traders are going to be the ones getting trapped most of the time, and not even just the breakout traders. It's even if you're trading support and resistance, if you're trading at a support level or a resistance level. So in this case, let's look at the area that I'm going to talk about right now today. The first area I want to talk about is this level, this area right here. There were some serious things going on in this area, and even myself probably wouldn't have noticed it right off the bat, but it's something that I always look for because I've talked about it many times with a lot of members previously. So just want to be able to show you guys what you need to be watching out for. So first of all, we're going to talk about some of the levels on the chart and some of the things that you can see happening at these levels. So first of all, this green level, this is going to be my, so I'm using my volume profile here. And so this is the HVA. So this is going to be the high volume area. And then the next level you're going to see on the chart is going to be this pink level, kind of magenta or whatever. This is going to be the POC, all right, the point of control. So this is the area where this is the most traded area. So this area, the value area, this is the value area high, value area low. All right, so this value area high, value area low, between here is 68%, basically 70% of the most traded volume throughout the day or the session or whatever time period you have your volume profile set for. All right, so that's what you got there. Those are the lines that you need to look at, because that's what I'm going to be talking about is some of these lines. So it doesn't just necessarily concern only these types of lines. It involves any horizontal support and resistance, any support and resistance level you could see this stuff happening at. But mostly these horizontal support and resistance levels that are going to be on your chart. So if we go back to this area here, I'm going to show you exactly what we got going on here. All right, so what we do have going on is this support level. And then we have this resistance level. So the market's in this kind of like a little consolidation. And this is where a lot of, basically a lot of volume takes place, because institutional traders are preparing for a move or preparing to move the market. So orders are piling up in here. And then a lot of retail traders are trading this support level. So at this support level, we trade it to the upper level. All right. And then at this resistance level, we trade it to the lower level. So we trade back and forth between these support and resistance levels. All right. And that's basically how support and resistance traders trade, and basically how most retail traders will trade. Unless you're a breakout trader, you're going to take these breakouts, or you're going to get caught no matter which way you trade it. All right. Because I'm going to show you what happens here. So first of all, under this level and above this level is a lot of liquidity. What is liquidity? Liquidity is basically volume, and it's orders in the market, tradable orders in the market. So where there's tradable orders in the market, that's what liquidity is. So the more tradable orders in the market, the more liquidity. So what happens at these levels is basically this. If I have a support level here and I tell you, look, we trade long at this level, and then we trade short at this level, where will your stop loss be? So we're entering at this level, and we're going to put stop losses down in this area. All right. And we're shorting this area. We're going to put stop losses up in this area. All right. So there is liquidity up here and liquidity down here. So what happens now, remove that so you can see just what happened right here. We go to trade long, all right? In the market, we have our stop loss down here. What happens is first, the market breaks to the downside. When this breaks to the downside, what happens here? A lot of breakout traders take this trade. So where are they putting their stop losses? They're either putting their stop loss above this candle or up above this zone area. All right. So they're going to have their stop loss there. The market drops. They get stopped out. The market comes back even higher. What does the market come back higher for? The market comes back higher because it's going to do the same thing on the opposite side. So when the market comes back higher, all right, what happens here? You have breakout traders taking this trade, putting either their stop loss at this level here or below the support and resistance level down here. What happens now is the institutional trader pulls up, grabs these traders here. Now they are trap traders, and then the market drops to the downside. They eventually get stopped out more down here. They get stopped out more, and the market drops even more. So basically what we call these are bull and bear traps. All right, and I tell people to watch out for this all the time. So what it is basically when you try to short here, the market grabs you in and then goes the other way. This is a big classic bull trap because this candle is even bigger than the candle that went to the downside. So it's trapping traders down here and they're stuck. All right. And most of them aren't holding until this point. All right. So that's where they're getting stuck, and they're getting stuck, dropped out of the market at this point and this point here. So that's a bear trap. And then the bull trap is basically this upper level where you see the breakout. You think the market's going to go. And then all these bulls are trapped. The market drops. They're stuck out here and here. And the market goes down the way you thought it would go at first. But it first comes back to grab y'all and then out. So grabs that and then out. And then what happens? Well, the market drops to a nice support and resistance level. So this is the PLC right here. Point of control if you're using volume profile. And if you're not using it, you probably don't have that level, but it may be another level that you look at. All right. But what happens then is the market comes back up into this area. Whoops. Grabs all these orders, more liquidity, and drops down. Comes up into this whole area here. This is where all this volume was. Grabs these orders and drops back to the downside. Back to this area, back down here, right back to the PLC. All right. So that's how you're being trapped. So how do you avoid that? Well, it's hard to avoid sometimes, especially if you're a breakout trader, even if you're just trading support and resistance levels, because again, you're going to go long at this level. And then you're going to go short at this level. So you be on a much smaller time frame than I am probably to catch this kind of area back and forth. But one thing that I like to wait for, I don't trade the breakout level. I never trade the breakout because I'm not worried about missing anything. Because if the market has liquidity here and this is a good level, it's going to pull back to it. So a lot of times it'll break and pull back. Then you can get in the market at that point and then go. So if it's going to break to the upside here, the market would break, pull back into that area and then go. And then if I don't catch the trade, if it doesn't pull back, then I just missed that trade, but I didn't lose a trade. All right. So I'm still sitting pretty where I was. Don't have anything lost or anything gained. So that's better than nothing, right? That's better than a loss. But that's how they're trapping you. So that's basically how they're trapping us. And you won't even notice it unless you really think about it, because when you see that breakout, if you're a breakout trader, you better be careful, even if you're trading the support and resistance like I mentioned, because just trading that simple support and resistance level still could get you caught up, all right? Because you get triggered into the trade, the market drops when you were going long, takes in all the breakout traders to the downside, and then boom, breaks back up to the upside. And you'll kind of notice it because what happens is it's a big candle most of the time. And a lot of times a classic one will be like an outside bar. So you'll see the first candle drops and then the next candle is an outside bar. All right. And that's a classic sign of what's happening right there. So when you see that a lot of times at a support and resistance level, be careful. All right. So hopefully that helped you out a little bit. Come back with some more stuff and show you some more things. Just trying to, basically I've been trading a lot of futures. So I'm trading that E-mini S&P 500, trading that micros. Hopefully this helps you guys out. All right. So till next time, guys, have a great one. God bless. So long.